One of the biggest areas, we've got a lot of coverage in here, and I'm not going to go over all of it, but I'm going to go over some of the fundamentals in related party issues, because these are one of the real tricky issues. The IRS in Regulation F basically creates a limitation that says you can do a transaction with a related party, but basically implicitly they are very concerned that somebody is going to take low basis property with a lot of potential gain, swap it for high basis property, and then let the related party cash out and sort of pass money under the table. Okay? And they don't say it in so many blunt words, but they do talk about cashing out, and that's what they're concerned about, is people basically doing basis shifting and cashing out what would have been a taxable transaction by creating a non-taxable one, or a tax-deferred transaction. Tarulla Brothers is the primary example of just exactly how far people will walk to do this. And basically what they did, they entered into a contract to sell a relinquished property on a condition that they would only do so if they could conduct a 1031 exchange. Red flag right off the bat. They knew there were problems in the front end of the deal, and they're trying to structure the contract that way. The second thing is they bought a replacement property from a company in which they owned a majority share. In the materials I think we have on our website, if not, they're readily available. We've actually bring out the code section as to what related parties are. Spouses are related parties, siblings are not related parties, children are related parties. Apparently people think your spouses, your parents, and your kids can be controlled, but you can't control your brothers and sisters and cousins. A company, business entity in which you have a 50% or more ownership in is a related, or more than a 50%. 50 is okay, a majority is not. And if you have a related party who owns a majority interest in a business entity, it's a related party. Trusts, same way. Okay? They had a company that they had a majority share in, therefore it was a related party. They wanted to buy the replacement property from that. That party was basically going to cash out of the deal. Okay? So basically this was a basis shifting transaction, and the IRS said they can't cash out of those proceeds and do this as an exchange, even though they avoided direct deeding by having the qualified intermediary deed the property. They put it into contract. It doesn't avoid the related party issues. The IRS is going to look to the substance of the transaction, not the form of it. And you have to think of this, you have to understand the shell game of a 1031 exchange to really bring this into focus. And here's the deal. If you do the table swap, okay, think about the table swap deal we talked about with a contemporaneous exchange, and we swap deeds. Okay? The IRS says you can do a 1031 exchange with a related party as long as the taxpayer and the related party hold their respective properties for 2 years. Okay? So if they want to know that it's a real exchange, they can do it, but they've got to hold it for 2 years. So if they do the table exchange and the taxpayer's related party sells the property they've cashed out, and they've disqualified the taxpayer's exchange. Okay? So where this really gets confusing is the IRS, as we'll talk about in a minute, says you can do relinquished property with a related party and it doesn't affect anybody. But you can't do it generally with a replacement property, because here's what happens. If the IRS made everybody pass deeds, didn't allow direct deeding, made you swap instead of have a sale and a subsequent deferred purchase, they actually made us toe the line and dot all the I's and cross all the T's and connect all the dots in a transaction, what would typically happen in exchange is the replacement property seller, okay, would swap their replacement property with the taxpayer at a table exchange. And then the replacement property seller would sell that relinquished property that they acquired in the swap to the relinquished property purchaser. Okay? So in so doing, they would get paid for that property. Okay? So they would be cashing out of the transaction, by selling to the relinquished property buyer. So that's, if the replacement property seller is a related party, when you look through to the core and substance of the transaction the way the IRS does, that means they're selling the property within 2 years. And that's disqualified under the rule that says they have to hold it for 2 years. And so that's where the related party issues are in a replacement property, because it's a clear cashing out as soon as that third party relinquished property buyer gets it, regardless of direct deeding, or as in Taruya Brothers, from the QI. They tried to get around that by not having direct deeding, and the IRS said, no, won't not work. Okay? Avoiding direct deeding and using a QI to receive and then deed the replacement property does not avoid related party issues. Cannot argue that the intent was to do an exchange. The argument that the transaction was conducted solely for tax avoidance purposes wins. The IRS always wins on that issue. Okay? So that was the related party issue. I've got a bunch of private letter rulings in these materials that I have more in there to illustrate the issues and also show you that there are certain exceptions to the rule that you need to be aware of. And while they are private letter rulings, these are ones we tend to rely on because the IRS's analysis is of case law and of explicit regulation and not one of interpretation. And therefore they tend to be much more reliable than very fact-specific ones. Okay? If the replacement property is part of the related parties exchange, the IRS has blessed that. They said that's not a cashing out. They're not really selling it to the third-party person because they're doing part of their own exchange. There was no basis shifting involved, and they will hold the properties they end up with for 2 years. And so the IRS blessed that. Narrow set of facts, but they did bless it. Okay? There's a private letter ruling on dealer properties and real estate investment trusts. Unless you are doing tax counseling of these things, it's probably nothing I need to spend a lot of time on. But if you are, you do need to be aware of this private letter ruling carve out, but limiting it to 7 sales and 10% of aggregate basis in order to basically be consistent with congressional intent. That's another area where you can probably get away without your own private letter ruling, but they're probably big enough players to do that. In 2007, we had a partition. A partition severalty is when, like, brothers and sisters own a piece of land and they decide to divide it up. Okay? They've done that. One of the related parties was going to dispose of theirs within 2 years, and the IRS says basically there's no basis shifting in a division. It's not contrary to the legislative history, and therefore there is no basis shifting, and they were going to bless this. It also involved timberland. One question we get a lot of is, can you exchange timber being sold for timberland? No. There is one case on it. The IRS lost the case, but they lost it on procedure, not the law, and a lot of people have missed that fact. Another one dealing with relinquished property to a related buyer. Again, the replacement property is coming from a third party, so it's not a cash out. The relinquished property buyer is related, but they're not selling, so they're not cashing out. Doesn't run across the analysis. Okay? Related party plans to sell within 2 years, but it's still not a related party exchange because they're the third party buyer in effect. There was no basis shifting, and the IRS blessed that. Makes perfect sense. I'm going to kind of move on past these things because we really ran a little time on these related parties, but there are several of these things in there. I do want to talk about leaseholds very quickly. A leasehold that either on the initial term or renewals, initial term or optional renewals, has 30 years or more left is treated by the IRS as if it is the fee simple ownership of the land. So you can sell a piece of land that you own as a taxpayer, and you can acquire as replacement property a leasehold with a lease that has 10 years left to run and 2 10-year renewals, optional 10-year renewals, and that will qualify as replacement property irrespective of whether you ever exercise the renewals or not. IRS will treat that as a like kind to the fee. So be cognizant short terms are tricky. You can exchange a short-term leasehold interest for a short-term leasehold interest under Section 1031, but the lease term's got to be very comparable. It's almost like doing personal property then. You don't see it much, and one of the reasons is because it's fairly tricky in that regard. The IRS requires substantially equivalent terms. Ground leases are long-term leases. You could do a reverse bill to suit with a related party exchange under a very narrow set of facts under this one revenue ruling. The IRS issued a revenue procedure after that that altered that substantially. Tenancy in common, complex area. You need to have a great deal of care in this regard. Why do we talk about it? Well, if you have three people that own a 1/3 undivided interest in a piece of real estate that they want to sell, one of those individuals can take their money in a qualified intermediary account as part of an exchange and buy another piece of property, either in whole or another undivided interest. It's their interest in the property that's being exchanged. The IRS doesn't care about the other people. That's their own discrete interests. The IRS treats it as a separate tract in their mind. Now, these tenancy in common investments have come into play because as 1031s were becoming very popular a number of years ago, and they're coming back into play as business is picking up after the real estate economic recession. And what's happening is we went through all these issues of people who want to remain invested in real estate, okay, but they got 45 days to identify. They want a good real estate investment. They don't have a specific one in mind, and time is limited. So how do they go about it? Well, people have filled the demand. They've come up with these tenancy in common interests, created them and structured them to be qualifying under the tax laws, and then allow people to buy. So suppose they got to invest $250,000. Well, they can buy a $250,000 undivided interest, proportional interest in this tenancy in common investment project and shelter their income. Now, it is a very, very compelling theory. The owner actually owns their undivided interest in the property. It's not like somebody's buying a stock certificate in real estate. Most of these things tend to be professionally managed. It's good for somebody who owns and wants to be remained invested and prefer income-producing investments and the stability of real estate. So there's a formula. And the benefits are it preserves the replacement choices in a limited period of time, shifts management to a third party where somebody might not want to invest income-producing property, not want to manage it themselves, permits owning a fractional interest in an institutional-grade property for a rather modest investment. Now the problem is if it's not structured properly, the IRS will characterize it as a partnership, in which case you'd be buying an interest in a partnership instead of an interest in land, and it'll disqualify the exchange if they do that. Okay? Red flags for the IRS as far as that is majority voting. Uh-oh. Now that takes out most of the people you know. That's just a very democratic thing. We want to be able to have a majority rule. And this takes that out because that sounds more like a partnership to the IRS. If profits are distributed purely pro rata, that sounds more like a partnership. Issued a revenue procedure in 2002. It's only a guideline. Okay, it is not a safe harbor. The IRS explicitly says that. This is what we look at. Okay, it sets out the rules for requesting a private letter ruling. Okay. That's what this revenue procedure is. This is what you tell us, and we'll give you a ruling. And by the way, these are the things we don't want to see. So it tells you, how to structure one properly. We want unanimity for major property decisions. Can't hold itself out as a partnership. No partnership tax return. Property manager can't share profits. May operate under a common name, such as Blue Hill Apartments or something like that. Substantial freedom to dispose of, in other words, you can sell your undivided interest without having to have majority approval, for instance. It's got to be limited to a maximum of 35 persons. The biggest problem with these things is when you follow all these things, you've created one pursuant to the IRS. If you get the private letter ruling, you're home free in your investment. As the questioner asked earlier, the question is, well, that's going to cost a bunch of money. Well, it's not going to be done by the individual taxpayer. It's going to be, should be done by the tenancy in common promoter, okay? Your pitfalls are dealing with an inexperienced investment company, somebody taking properties that really are not investment grade properties. You know, it turns out to be swampland in South Florida or something like that. And in my world, they have not applied for a ruling by the IRS, private letter ruling. If you're investing in investment grade tenancy in common, they should, in my view, have invested in a private letter ruling. So this is one of the cases where I'm talking about, you're usually talking about millions of dollars of investment. Why in the world, when the IRS has said it's not a safe harbor, wouldn't you get a private letter ruling? Okay? Sometimes you're dealing with inexperienced QIs. Property managers are selected on a low bid, and they do net leases on these things instead of triple net leases, so you end up having to contribute capital if they start running short on operating funds. Never let the tax savings drive sound investment decisions. Be careful that there aren't burdensome buyout provisions. Consider the fact that if you sell an undivided interest in a tenancy in common, it's going to be sold at a discounted value from a full interest. Okay? Remember that because it's an undivided interest, you can't run down to the bank and cash it out really quickly. You're going to have to bind the buyer. Okay? On top of that, the Securities Administration has taken a position in the past, and it's not resolved to this date, that dealing in these transactions may actually be dealing in securities. And it doesn't matter what the IRS says about it. If the Securities Commission says it's dealing in illegal securities, you got a problem. So there may be some future regulation in that regard. How are we doing time-wise? Huh? 10 minutes? Okay. Be aware of Delaware statutory trusts. These things have a very good structure for holding property in common with other owners without running afoul of all the tenancy in common issues. They have been recognized by the IRS as being appropriate for 1031 treatment, and owning an interest in a Delaware statutory trust is equated to be owning an undivided interest in the real estate held in the trust, because they are nominee trusts. They're not trusts in the fiduciary sense. They're basically there just to hold title. IRS has some rulings in their revenue procedure on the thing. They're very handy because lenders are reluctant to make loans secured by property with a bunch of tenants in common. This solves the problem. Title's all titled literally in the trust. The revenue ruling in 2004 opened the door for this. It permitted tenancy in common ownership to be considered owners of the property for 1031 purposes. It limits the trustee's right to make any modifications to the improvements, to make certain cash investments, to acquire property, to renegotiate loans. These are all problems. To refinance the debt, to enter or to renegotiate any leases for the property. As a result of these limitations by the IRS, for these to be investment vehicles, typically what you're going to see is they're going to be like a 5-year lease. Okay? So that basically the lease will expire and then they can renegotiate everything and recreate the new trust terms and not run afoul of the IRS regulations. Most of the people dealing with that are not going to be real happy with short-term leases, since the long-term ones will need reinvesting, and people want longer-term investments. So you have limitations in that regard. Illinois land trusts are common law trusts, first recognized in Illinois. Again, they are nominee trusts. The trustee is not treated as the beneficial owner of the property. Rather, the trust beneficiary is. The IRS recognizes that ownership and says you own the land as far as we're concerned. As a result of these two types of trust ownership, people have wondered, can you do this in North Carolina? And I often caution people, I say, North Carolina does not recognize the formation of an entity trust under our law. We recognize one lawfully formed in jurisdictions that recognize it, such as Illinois or Delaware. And the question is, I don't think that you get our revocable trust provisions sound very close to the IRS requirements, but they're not quite all the way there. And so I tell people, if you're advising North Carolina residents who want to take advantage of entity trust, nominee trust ownership, and 1031 issues, then you need to get a Delaware statutory trust formed in Delaware by somebody competent to do so there, and then have them follow the North Carolina statute for recognition in North Carolina and operate in North Carolina if that you want to have the benefit and not have any of the associated risks of doing it on the fly. Any other questions?
Can you explain the impact of carryover equity as it relates to a 1031 exchange?
All right, the question is, can I talk about the carryover equity? That sort of gets back into the debt netting and mortgage debt netting issues. And you know, the IRS doesn't care about equity at all. There are no Internal Revenue Code regulations on how much of your equity you can borrow out of a piece of property. And as a result, there's very little in the way of any equity issues with regard to 1031. What it tends to be is the debt itself, okay? And it becomes a business driving decision on the equity as to whether you can actually borrow enough money in the new property to pay off all the debt in the old property and those sorts of things. And they get to be calculations, but they're calculations basically across the debt netting, which is pretty well laid out in the regs. There's about 4 examples on debt netting in the regulations. So it can be kind of confusing math, and you have to walk through it carefully. The one caution you have to have in 1031 is don't borrow a bunch of money just before you close on your relinquished property just so you can cash out your equity ahead of time, because if the IRS perceives that that was done as a scheme to cash out and use debt netting to your advantage for tax avoidance purpose, they can again ignore the form of the transaction, look to the substance. So you don't want last minute borrowing, and you don't want first minute borrowing on the other end. They have a very suspicious look for the IRS. People, there's only really there's a couple of holding periods. One in dealing with converting replacement party, personal residence, converting from investment property. It's in your materials. It's a 5-year holding period, 2-year for related parties. The rest of the time there are none. And a lot of people will take the related party 2 years as a roll. As a guideline for holding periods. I always tell people, if the IRS hasn't set a holding period, there isn't one, and the best holding period is at least across one tax reporting period, so that all of the facts of the transaction won't show up on the same tax return. That's just a practical approach. It's not a legal approach. The other issues that you have to deal with, will come in on these netting rules and cashing out rules. If you run across a specific example in the regs that doesn't make sense, give me a holler. I'll open up a copy of the regs. We'll take a look at it. Other questions?
Sole member, so individual sells relinquished property, forms an LLC to acquire replacement property. That's allowable. Husband and wife own relinquished property, won't form a 2-member LLC for replacement property. I've seen something out there where you have to be in a community property state for that to be recognized.
Okay, the question for the online audience, if you have, the IRS has recognized that an individual can sell real estate and acquire replacement property in a single-member LLC. And there's no problem with that with regard to violation of the same party rule. The question becomes, if you have a husband and wife owned property, can they sell relinquished property that they own as husband and wife, but tenancy by the entireties or tenancy in common, either one, and acquire property in an LLC in which they are the 2 sole members? And the only thing I can say is the IRS's express position on that is we're studying it, we haven't taken a position, which I take as bad news. And the reason for that is that within a membership interest in an LLC taxed as a partnership, the individual partners, as they're treated under tax law, can allocate depreciation, they can allocate basis among their respective interests. And I think the IRS is really, without saying so expressly, concerned about the basis and depreciation allocations that can occur in that form of ownership, and that's why they haven't come out and said yes.
Is there any limit to the time that you can transfer it, the husband and wife transfer it into an LLC prior to relinquishing it?
Great. That was one thing I wanted to touch on. We ran out of time. I wanted to talk about drop and swap and drop. They're in the materials. There's also the basic same thing on our website. When you look through all the cases in dealing with basically changing the ownership in order to accomplish an exchange, the IRS is concerned about why are you holding the property? Are you holding it for the purpose of selling it or holding it for investment and that? And when you do swap and drop, and what a swap and drop and what a drop and swap is, if property is held by an LLC, and the LLC wants to sell the property, and one of the LLC members wants to do a 1031 and the other one doesn't, then what they can do is distribute the property to them as tenants in common. That's drop, okay? Conduct the exchange on the 1/2 interest, that's swap. So that's drop and swap. And the other way would be to do it is to basically swap and drop is for the couple to do the exchange and then take the property that they've acquired as a tenancy by the entireties and convert it and transfer it into the LLC. That would be a swap and drop. And there are a lot of considerations, and the IRS has approved a few, and they have rejected a whole bunch, and it's always around the holding issue. And again, my caution is as a practical approach, don't do the swap and drop or the drop and swap except across the tax reporting period if you can avoid it.